I'm so sorry. I'm so sorry. I didn't realize that my mic was on mute. I'm so sorry. Someone should have. Am I audible now? Please mention so that we can proceed further. Am I audible? Okay, done. The next topic what we have is performance measurement and control. So the the performance of the employees in the organization or the performance at large, if the performance has to be measured, we have various tools which are to be taken into consideration. The best among them is ratio analysis. With the help of ratios which are calculated, the performance can be measured and analyzed. You have learned this particular thing in management accounting, okay, but how seriously you remember that, not sure, but then um, from today onwards you just remember that this is a tool which you will be depending on, even not only for these exams but even when you're working in an organization. The best tool which you can use to um, evaluate the performance, measure the performance, so that is ratio analysis. So that's the best tool which is available. All the ratios which are there available, they talk about some aspect of the organization, something or the other can be known from ratio analysis. So the first thing is ratio analysis. Apart from ratio analysis, we also see that um, PIs are performance indicators. Okay, the ratio analysis basically talks about the financial aspects. From the financial statement, the data, the information, whatever is available, that is taken and some insights are drawn. So mathematical presentation of various variables in the form of an equation is a ratio. But performance can also be measured in non-financial parameters also. So what are the non-financial performance indicators is the next part of it we are going to learn. After that, we see what are the behavioral considerations. So those things have to be wherever, henceforth now, wherever, whichever paper, if there is anything which refers to the performance part of it, these things appear there. So you cannot just study and leave it for one time. No, it will continue. I'm telling you, even when you're working, also you will have to depend on these parameters because you would be ultimately working um, and checking up, working in corporates and then checking about what is the performance. So when you are looking at to measure the performance, these are the tools which are available. The first one, ratio analysis. Now, theoretically, what is the meaning of ratio? We see that a ratio is a mathematical expression of two variables. So, two variables from the financial statements are selected, and with the help of these two variables presented in the form of a ratio, it helps us to understand some aspect of the organization. Something can be known. So, various ratios are used to calculate and understand the financial position, the various aspects of the organization. So, um, ratios may not be representative of the position throughout a period, so it may be changing. So there are certain important points or assumptions what we have to look into or take into consideration. Is the first one is it may not be representative of the position throughout the period. As the variables keep changing, ratio value also keeps changing. So that is an important thing. As the see, sales is not forever the same. Sales would change, then profit also changes. So if we are talking about the profit margin or profit percentage, that is applicable only for a period of time. After the period of time, when the sales value changes, then again the profit value also changes. So the profit margin also changes. So forever the same values are there is not the criteria. Next, need a basis for comparison. In itself, they do not mean anything. If they are used in on a comparative note, then that makes some sense. See, if there is a profit margin of 10%, so it may look 10% is pretty good and 10% is good, but then unless and until it is compared with some other entity, maybe a competitor or maybe the industry average, it is not known about whether it is good or not. So it should be compared, and on comparison only we can understand it better. So let's say for a unit of, if a business has a profit margin of 10%, competitor has a profit margin of 12%. If there is no comparison, 10 may seem to be good. But if the competitor has a profit margin, has earned a profit margin of 12%, then 10 is not good. Relatively, it is lesser than the competitor's profit margin. Then measures would be taken to look into what are the reasons why they were not able to earn on par with the competitor or something like that. So ratio in itself do not convey the whole thing. Um, when they are used for comparison, then um, that gives the much clearer insights about the performance. Then ratios can be manipulated. Okay, there is a possibility of manipulating the ratios. So the assumptions differ when we talk about what is a particular ratio, the value of a ratio, the formula of a ratio, we have a numerator and denominator. So each numerator, when we elaborate that, what should be included in that? For example, let's say that um, if you're talking about profit margin, what is profit? Profit has so many meanings of that. Profit could be a gross profit, a net profit, what we understand. There are other terms of profit also, like operating profit, profit before tax, profit after tax, profit available to shareholders. So which profit are we referring to? So that is one thing. So when we talk about profit margin, it could be profit before tax divided by sales into 100, or profit after tax divided by sales into 100. Let's say if there is an ratio called as receivables turnover ratio. Receivables turnover ratio is credit sales divided by average receivables. That's the formula. But then let's say that if credit sales information is not there, just because of lack of information, they may also take total sales in the numerator. So we do not have a standard thing which has to be all the time taken into consideration, but alternative views or any figure which can be replaced is also used and ratios are calculated. So they can be manipulated. Ratios indicate areas for further investigation rather than giving answers. So ratio analysis only does not give a solution to the problem, but it can suggest about what other areas into which probing can be taken up. How should they investigate further, look into those areas further, and then identify what has to be done. See, technically, the classification of ratios is given in different ways in different textbooks. The Of course, our Indian textbooks, what you will find it in your library also will talk about different opinions. Um, See, broadly speaking, many of them take this to be as four categories, but five people to take five categories are also there. But ultimately, all the ratios which are presented under different headings talk about that particular aspect. Here, in case of this particular material under Kaplan, first category is we have profitability ratios. The second one is liquidity ratios. Third, we see that risk measurement, or what we call it as financial ratios or capital structure ratios. Then So these are the categories which are discussed. So you have to remember these ratios. The first one is profitability ratio. Basically, profitability ratios talk about what is the profit margin which is available on whatever is the parameter, the other variable which is taken into consideration. From the income statement, if we look into the income statement, has certain ratios. I'll just put it on the word file. From the income statement, we have gross profit, we have net profit, we have operating profit. Anyway, it is here. Gross profit margin. So the logic here is if sales is 100%, what is the percentage of profit? The profit is what percentage? So profit into 100 by sales. So it could be gross profit, it could be net profit, it could be operating profit. See, whatever is the profit which has to be calculated, we calculated that way. Gross profit, operating profit, then net profit. What is this percentage? So take the profit margin, multiply into 100 divided by sales. Then there are certain profitability ratios also calculated from the balance sheet. The balance sheet talks about what are the total assets and total liabilities. So the total investment made into assets is written on total assets. What is the total capital which is raised from debt capital, raised from equity capital? The total is called as capital employed. So if the total capital employed is taken as the parameter, capital employed if it is 100%, operating profit is what percentage? So that's how ROCE is calculated. Then we have ROI. Apart from ROCE, we have ROI. ROI also talks about what is the profit margin divided by the investment. ROA is also there. It talks about profit divided by total assets. So all these three are interchangeably used. Profit divided by investment. So investment is what basically investment is the funds which are raised to be invested into the assets. So we see that ROI, ROCE, ROA also. There's another one which is called as ROA. ROA talks about the profit which is available divided by total assets. So if that is the case, all three of them, the numerator is same. So the denominator, the terms differ, but they convey the same meaning. The terms are, it is total capital employed, the total capital which is raised and used. So used for what? It is used for investment. Invested into what? Invested into total assets. So they basically talk about the same thing. Technically, there may be slight differences, but most of the time we see them, they are interchangeably used and calculated. Apart from that, we have turnover ratios, the asset turnover ratio. So any turnover ratio would indicate that the investment into that particular variable should help in quick conversion into sales. Only when there is sales happening, the possibility of profit will arise. When they can convert their investment into that variable. Let's say that total amount which is raised, if that can result in a higher amount of sales, profitability scenario arises. Any amount of assets which are invested into, if assets can be converted into sales, so asset turnover ratio. So sales by total assets or sales by capital employed. So that indicates that the investment into assets is not blocked there, but that is helping in realizing sales to happen. So that is converted into sales. We have individually each of the current assets like receivables turnover ratio, inventory turnover ratio, then liabilities, we have payables turnover ratio. So what do they talk about? They talk about how quickly is the operating activity taking place. Unless and until sales happen, the concept of earning a profit does not happen. So the efficiency is understood by way of turnover ratios. So the turnover ratio is any investment made into any particular variable that has to be converted into sales. So that's the important point. Okay. ROCE is split into two different aspects of it. What is ROCE? The formula of ROCE is operating profit by capital employed or total assets. Okay. Um, this is elaborated as asset turnover into net profit. Net profit margin will be profit divided by sales. Asset turnover is sales divided by total assets. So ultimately we would have profit divided by total assets. So sales and sales get cancelled. Return on capital employed or return on total assets is ultimately the same thing. But we get to understand what is the margin of asset turnover ratio, what is the profit margin. So these two things can be understood. So a set of ratios talk about the profitability aspect of it. After that, we have liquidity ratios. What is the meaning of liquidity ratios? Liquidity ratios are liquidity situation talks about ability to convert their um, current assets into cash, and with the cash meeting the payments. See, in the balance sheet, we see that there are two different on the asset side and the liability side. We see that there are current assets and that they are fixed assets, broad classification. Current assets are those assets which can be converted into cash in a period less than 1 year. Fixed assets are those assets which cannot be easily converted into cash. Okay. Then on the liability side, there are three categories. One is the current liabilities. Then we see long-term liabilities, that is the debt capital basically. Then we see equity capital, long-term liabilities and equity. These are long-term, this is short-term. So when the reason why they invest into short-term assets is the cash is not kept idle all the time, because cash kept idle um, doesn't give them any return. Um, so they invest into some investment form wherein they can earn some return. That's the purpose. But yet at the same time, they also have to understand that they need to make payments from time to time. So cash availability is also very important. So a portion of the investment amount is made into current assets, or that is also required to run the business, to operate the business. That is, with cash they purchase raw material is converted to finished goods are sold, and then after sales and credit sales happen, and then at the end of the period they get back the cash. So that's the operating cycle. So now the to run the business, they have to invest it into current assets, that is inventories purchase, they sell on credit. They also see to run the business, the operating cycle, the amount of cash is invested, that is into raw material gets converted into finished goods, then finished goods have to be sold, then sales happen if they happen on credit basis, so credit sales happen. So to run this business, to see that the operating activities take place also, they have to invest the amount into their operating activities. So the current assets. So these two are inventory. This is receivables. Okay. Then to run the business, to operate the business, they also require material. So material has to be purchased. Sometimes when they are due to pay to various parties, they have to make the payment to them. So now here we see that current liabilities also keep arising from time to time. If they purchase material from the supplier on credit basis, the supplier has to be paid to meet all their operating expenses like rent or salaries or other operating expenses, anything which has to be made. That for that reason also they have to have cash. So they take a decision about investing in current assets and current in such a way that the current assets, when they get converted into cash, this cash is available to meet the current liabilities. So a decision about what portion of current assets are invested into and what is the amount of current liabilities. So these things can be understood clearly by way of calculating liquidity ratios. Liquidity situation is the situation where it talks about their short term position. How sound are they in the short term? Can they meet all their payments in the short run? Is what has to be looked into. Um, and that is possible by way of calculating the liquidity or the working capital ratios. The first in the list is we have current ratio. Current ratio is equal to current assets by current liabilities. Then we have quick ratio. Quick ratio is all the current assets are quick in nature except the inventory, because from the operating cycle we see that that is the one which takes the longer period of time. From here it has to get converted into cash. It takes a longer period of time. So it is not a quick asset. So we see that all the current assets except inventory, and we also see prepaid expenses also not easy to be converted into cash. So quick assets by current liabilities. Then individually for each of the current assets, we have a turnover ratio called as receivables turnover ratio, which is credit sales divided by receivables. So that converted into the number of days. We have the concept of receivables days. So the formula would be, in a year there are 365 days. So 365 days divided by receivables turnover ratio. But what is receivables turnover ratio? Receivables turnover ratio is equal to credit sales divided by receivables. So credits, so this part of it is credit sales divided by receivables. So if there is a fraction in the denominator, to bring it to the numerator, this has to reverse. So 365 into receivables by credit sales is the number of days receivables. What does this indicate? What does this ratio indicate? It indicates that in a year of 365 days, for how many days did they extend the credit? How long is the amount held in receivables? Because once they invest in a current asset, the um, amount will be blocked there. So, for how long is the investment held in a particular variable is what is calculated. Then we have inventory days. Inventory days is equal to the same formula, the same logic. 365 days divided by inventory turnover ratio. But inventory turnover ratio is calculated as cost of goods sold. The formula for this one is cost of goods sold divided by inventory. So it goes to the numerator. So 365 into inventory by cost of goods sold. So that's the formula. So how many days is the investment into inventory held in inventory only? How long does it require, or how many days does it require for inventory to be converted into cash? So payables on the other hand is a liability. If the material is purchased from the suppliers on credit basis, how many days of credit period are they enjoying? How long can they delay the payment made to the supplier? So that is what has calculated. So overall, to calculate what is the operating cycle days, the operating cycle days will be the receivables days. If this is 1, if this is 2, and this is 3, operating days would be operating days is equal to receivables days plus the inventory days minus the payables day. Okay, so the current assets into which the amount is invested, how many other days it takes. From that, what relaxation can they have in terms of making the payment to the suppliers? Talks about operating cycle days. So these ratios and according to the requirement, anything which is taken up to understand the short-term position of the business, we call that as liquidity ratios or working capital um, ratios. Next, we have ratios to measure the risk. Risk is a situation which arises because of the long-term capital structure. Basically, we see that there are two different types of capitals. There are two types of capitals. One is debt capital. The other one is equity capital. Two types of capital. We have features for debt capital and equity capital. In case of these capitals, if we talk about cost is low in case of debt capital, and equity is in case of equity it is high. In case of risk, debt capital has high amount of risk and equity has low amount of risk. Why would this be? See, debt is an investment made by the outsiders. Equity is the investment of the owners. Equity is the shareholders' capital, which is invested. Shareholders are the owners of the business. So whatever amount which they invest in the business, the contribution of the owners, we call that as equity. The contribution of outsiders, we call it as debt capital. Okay. Debt capital has a time period. no matter how small, how long it is. But at the end of the period, the total amount of capital, debt capital, has to be paid back to the outsiders. Apart from the capital, periodically also they have to be paid interest amount, which is an obligation. Whether the company earns profit, not earns profit, incurs losses, whatever is the situation, they have to be paid interest. So even if their cash position is not good, their financial position is not good also, it is an obligation. The company has to make the payment. Okay. So on account of that, because it has to be paid, and then at the end of the life of the debt capital, the total amount has to be paid. But funds would not be available that they can be paid back because they are already invested into some investment. For that reason, they again have to raise another loan. To pay off this loan, they have to raise another loan. So the risk aspect is high in case of debt capital. But that's not the case in case of equity capital. Why? Because they are owners. When there are no profits, they cannot demand for a dividend to be paid. They do not compel, or there is no obligation which has to be met in case of equity capital, that dividends have to be paid. Okay. There is no time period for equity capital. As long as the company exists, the capital is there with the company. Fine. So that pressure to make arrangement for funds to make the dividend payment, to repay the equity capital and all, is not there. Therefore, on account of that, we see that the risk on equity capital is low. What about the cost part of it? The cost the cost of debt capital is low, because at the time of issue, whatever is the prevailing rate, that at that rate debt capital is issued. So it would be applied until the end of the life of the debt capital. Let's say debt is issued for 10 years. The same rate will be applied to make the interest payment on debt capital. There would be no fluctuation. Even if the interest rate in the market also varies, it still would be the same. There would be no change in the interest rate. So it is overall a cheaper form. So we see that the rates keep rising, but this doesn't rise, so it becomes cheaper. On the other hand, equity, we say that there is no obligation to pay dividend, but if the shareholders are not paid dividend, they become dissatisfied. When they are dissatisfied, then they do not continue with the company. They sell away their shares in the stock market. That possibility is there, that they can sell away their shares in the stock market, and then discontinue to be the shareholders of that company. See, if somebody is selling the shares, it sends a signal in the market that they are not interested in being the shareholders of the company. So they are selling away their shares, and that news, if it spreads in the stock market, everybody starts selling away. So that is the psychology which prevails in the stock market. When everybody wants to sell away their shares, the share price falls. When the share price falls, the market value falls, the value of the firm falls, and no other stakeholder will come forward to transact with the business. So that leaves a negative impact on the business. This is all on account of the shareholder not being satisfied. When would he not be satisfied? He would not be satisfied when dividends are um, he, they are not paid. Then there is dissatisfaction on the shareholders. So to satisfy them, company makes it an effort to earn better returns and make the dividend payment. So to just to satisfy that. See, implicitly there is nothing mentioned that there is an obligation, but there is a subtly there is some pressure on the company to satisfy the shareholders. Shareholders' profit maximization is their objective. So to satisfy them, they have to earn better returns, pay out of the returns which are earned, a portion of it is paid, or entire thing is paid, whatever it is. So they're always in the pursuit of earning better returns and satisfying the shareholders. So on account of that, we see that So the return which is earned and paid to the shareholders is nothing but cost for the company. So cost is high in case of equity capital. So there are advantages and disadvantages with each type of capital. Coming to the next set of ratios, which are capital structure ratios or risk ratios, or we also call them as leverage ratios, solvency ratios. These are all terms which are used for that. Now, these ratios basically talk about what is the proportion of debt capital and equity capital. Because each of them have one set of advantage, one set of disadvantage. Considering that, what should be the proportion of these capitals to be invested? See, if debt is more, the risk is more. If equity is more, cost is more. So, to have a balance between the advantages and disadvantages, the right proportion of these two capitals is they should be equally invested. Okay, equal amount of investments of debt capital and equity capital should be employed in the business. So there are certain ratios which talk about what is the proportion of debt capital and equity capital in the total capital, gearing ratio in the total capital, debt plus equity, what is the portion of debt or what is the portion of equity. So various ways and various terms which are used which talk about what proportion of these capitals are employed in the business. Then we see dividend cover. Dividend cover is equal to what is the amount of profit which is available to make the payment. We have first interest coverage ratio. So if we talk about the um, income statement format, we see sales minus cost of goods sold is gross profit. Gross profit minus operating expenses is operating profit. Then um, non-operating expenses and incomes. Considering that, we see the resultant figure is EBIT. So EBIT is the base from which all the other I'm just looking at if I can put a. No, I'm just looking at. I keep typing this income statement format many times, so there must be somewhere is what I'm looking at. If I don't have, we'll proceed further. Um, quickly I will type it here. Sales minus, we have cost of goods sold. This is called as gross profit, minus operating expenses. We call this as operating profit. Then minus non-operating expenses, and then we have add non-operating incomes. The resultant figure is called as EBIT. So EBIT is the profit which is available to all the investors. So out of EBIT, the first preference is given to interest. Less interest. This is called as EBT, earnings before tax. Then we have it as less tax. This is called as EAT, earnings after tax. After that, the first preference is given to preference shareholders. So less preferred dividend. After preferred dividend, we have it as net income of common equity shareholders. So now this is the format. I wrote all um, short forms, but